Hello everybody. So quite a crazy earnings day today. Q2 sell-offs is the title of this video. I'm going to cover 3 stocks that I have in my portfolio. Delcath was technically up, but given that it ended the day at like plus 1% versus in the morning plus 17 or 18%, I'm going to count it as a sell-off for Delcath as well. The market makes no sense except maybe for ELF. We'll see about ELF. We'll see what's going on with ELF. So let's get started. Let's talk about Delcath. So Delcath. It's a cancer for it's a liver treatment cancer. It's a cancer treatment for liver cancer. There's multiple kinds of liver cancer. Their type of liver cancer is metastatic uveal melanoma, and it's a rare kind of cancer. And they have this system, which is a catheter system. It cuts off the liver, and you can have precision therapy injected into the liver. Kind of groundbreaking, very good outcomes. Hospitals are rushing to adopt the system. More than half the patients who have this diagnosis really don't have a solution, and so they're expanding really fast. They're expanding faster even than last quarter. Lots of fear about people saying, "Oh, there's only 800 patients." That's not a big total addressable market. Given that this is a very expensive treatment, it actually is a lot of money for this company. And I believe they will be able to acquire a bunch of these 800 patients, and the numbers speak for themselves. I'll get to the numbers in a second. Of course, it's a one-trick pony. You may not be interested in just a company that treats one type of cancer, of liver cancer. This company is trying to treat all sorts of different type of liver cancer, and you can see they're working on all of these indications that could take them to maybe 40,000 patients potentially being treated by the Delcath system, knowing that liver cancer first are already not that common. They're not very rare, but it's not the most common type of cancer, right? Google tells us less than 200,000 cases. They've identified maybe about 40,000 cancer a year on which their system could be used. But of course, that's down the road. Of course, we would have to wait until maybe 27, 28 to see another one, and then maybe another few years to see another one. So this is a long-term story, and the market right now is so short-term looking. The market has no patience. This stock was up in the morning, up 21% from the day prior, plus 21% from the day prior, and all day long it lost its gains. That was very depressing to see. All day long down 16%. I don't care. This is a long-term hold for me. The fundamentals are just outstanding. If you look, keep in mind, this is quarter-over-quarter growth. We will get in a second to ELF. ELF is maybe not going to have 22% for a full year. This is quarter-over-quarter growth. So quarter-over-quarter plus 22%. That's quite outstanding. This is growing very fast. If you analyze that, I believe you're going to near 100% probably growth. I'm still using the revenue growth, 100% revenue growth next one. I'm still using the analyst number in my spreadsheet here because 120% is kind of my average that I'm seeing. The numbers haven't changed. You still have some people who are saying this company could do 300%. By the way, that's the tough one. How much are they going to grow? It's tough to know. But I will point out that they paid off their debt. They have more cash. They've increased their cash, paid off the debt. And I will point out in my spreadsheet that this 40% EBITDA margin, that is not a typo. That's the actual EBITDA margin this quarter. That is not a typo. I calculated it 2 times to make sure. And so now we end up with a company, that really looks outstanding. On EV over GP over RG, assuming 120% revenue growth, you're getting a 0.04, so that's dirt cheap. But the rule of 40, he's achieved alone by an EBITDA margin of 40. That gives you a rule of 40 right there. But if you had 120% growth, you get a rule of 40 at 160. So this stock, again, nobody wants to invest in that, I guess. I mean, it's not a very enjoyable thing to invest in, but there's a real need, and clearly they're having some traction with the reimbursement because. And that's one last thing I'll conclude with, is these rare diseases typically Medicare, typically even private payer, like administrators of Medicare Part D plans and all that sort of stuff, they typically don't look twice because it's only 800 patients a year. So they're less likely to argue on the charge. And of course, these treatments are very expensive. From memory, I think it's like 80 or 90 grand or something like that. It may be more. That's just from my memory. But these are very expensive treatments. And Medicare is paying because it's rare. And oftentimes you see a lot of these companies who specialize in rare diseases, they can get reimbursement much more easily. There's a bunch of exemptions for rare diseases, right? It's not like a GLP-1 where one American out of 3 qualifies. This is something that payers will pay for. And so you get a stock that is dirt cheap, a stock that did outstanding, yet it sold off all day long. And so whatever. I'm a long-term investor. Doesn't matter for me. Let's talk about TGTX. So TGTX is even worse. TGTX is a stock who did everything outstanding. They now estimate that in moving market share, in people really starting the treatment on MS. So this is a treatment for MS, so multiple sclerosis. There's 3 treatments approved for MS. One of them is, I'll kind of put aside. It's really Ocrevus and Vema. Again, I'm not a neurologist, but from what I understand, their treatment is the newer treatment, and it is a quicker treatment. So you don't have to spend the whole day at a transfusion center. It's not a transfusion. It's more like a injection center. You don't have to spend there all day. You can do it much more quickly with BRIUMVI, and it's the latest drugs. And so because it's the latest drug, it's got fewer side effects. One of them is I believe it's an indication of breast cancer, that they don't have that in there. So the newest treatment, the bigger deal, of course, of this is that the FDA said they were done approving treatments for multiple sclerosis. They're done approving treatments, and so that means that their treatment is protected until 2042. They created an oligopoly until 2042. And they're done approving new treatments. And so as a result of that, there's really 3 choices for anybody who has MS who wants to have a CD20 therapy. And them being the new kid on the block, the new drug on the block, they are seeing a lot of adoption and they're taking market share. And that's the second time in a row that they raise their full year guidance. They're raising the guidance again. So you raise the full year guidance, you have a market share that's moving up. You're telling us that Q3 and Q4 should be much better than Q2 and Q1. And Q2 and Q1 were not bad at all by any means. And then you had a stock yesterday was down 20%. So, whatever. This is a stock that's poised to bounce, in my view. This is a cheap stock. EV over GP over RG is a 0.21. Rule of 40 is a 72. Forward growth projected as a 53%. Gross margin 87%. I like this stock very much, and they have kind of a wild card, which is the Mio Gravis, which may be another application, and the sub-Q BRIUMVI, which may be another application of their product. So you have a product here where the numbers look very good in my view. It's a much more unfortunately it's a much more prevalent disease. But this company, in my view, is firing on all cylinder. I am happy to own this biotech. And the last company that reported today is ELF. And so ELF I've covered a few times on the channel. I used to like it a lot when it was like at 54, 55, like under 70. I used to like it a lot. I don't like it as much as 110, although it should open tomorrow at like 100, roughly. So we'll see. We'll see how low it goes. Of course, this company is being hurt by tariffs right now, and they're showing a decline in profits. CNBC had this as their headline, actually. It was a CNBC headline about an hour and a half ago. So there you go, CNBC, always looking for the negative and putting it in front of a headline. I don't think the profit headwinds are going to last, though, because you see effective August 1st, so as of 5 days ago, they increased pricing on their products by $1. So they should recoup a lot of these losses. But this is a company, of course, that is being hurt with the tariffs. The tariffs are not helping, and they make still 75% of their products in China. I would love to tell you a little more about ELF, but I'll stick to the text and tell you that the revenue is up year over year only 9%. That is disappointing. If you look at, and again, when I was covering this stock 6 months ago, I would have hoped they would do much more than that. If you look at their chart, their presentation, you can clearly see that the sales are beginning to stagnate. And so I don't know how much competition. I don't know if there's competition. I don't know what's going on. I wish I would tell you more, but the annoying thing about ELF is that I think their marketing department is doing the slides for an investor deck, and so it's like 85 slides with like only teeny tiny pieces of information, and it's in 300-point font. Like, for example, this $1 effective August, that's like one slide. That's one slide, and so you're trying to pack your information across 85 slides. Think about it. That's like a small book. And so I wish they made their commentary more concise. It's kind of all over the place. I get that they're a marketing machine, and they're a good marketing machine. Clearly, they are the number one or number two on their cosmetics space if you look at them. But there's also clearly a slowdown at plus 9%. And so I do not like that. In my spreadsheet, I was very kind to them. I mean, I am keeping the analyst number of 23%, but I perused through the call a little bit, and some of the analysts were a little disappointed. They were questioning the growth here. So I'm guessing the number of 24% is going to drop. But either way, in the beauty space, I'm back on my initial, lover in the beauty space, which was Oddity. Odd. I love Odd. I think Odd is kind of like in the sweet spot between, higher EBITDA margin at 29%, higher gross margin. Odd is fully direct to consumer. Odd is, and they have like a skincare thing, but it's still mostly foundation, so only one product. Well, they have another brand too in Spoiled Child, but at least their initial brand is well targeted. I like Odd better right now. I like these numbers better, and of course you may remember when I was covering ELF, when it was it went down to like it went below 50, but in the mid 50s when I was covering it. You may remember I was very into it in the mid 50s. Now we're at 100. I don't like it as much as 100. I still think the company is just fine for a long term. I think it's just fine for a long term, but I think they need to figure out that 9% year-over-year growth, that's not very good. They need to grow a little more. Maybe they didn't spend enough on marketing. I don't know. I remember them reading briefly about marketing, saying they were spending less on marketing. Maybe that's the reason. But clearly a period of slowdown for ELF, and I would argue that the minus 10% is a warranted drop for a stock like ELF. So hopefully you found this helpful. Pretty disparate stocks today, but hopefully you found this helpful. This was not investment advice, not financial advice. Only entertainment. I hope you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.